Gold, $4,886. Silver, $84. What every investor must know right now. Gold at $4,886. Silver at $84, down from historic peaks just 48 hours ago. But here's what the data is showing that nobody is talking about. Central banks are still buying. The supply deficit is still widening. And 3 major investment banks just issued conflicting forecasts. One predicts $6,000 gold by year end. Another warns of a collapse to half current levels. Both cannot be right. But one of them is about to make or destroy fortunes in the next 90 days. The question is not whether you believe in precious metals. The question is whether you understand what these specific numbers are telling you right now, because the window to position correctly is closing. Welcome to OW and AG, where we analyze markets the way serious capital does, with data, with discipline, without the noise. If you have been building wealth long enough to know that markets reward patience and punish panic, then this channel was made for you. We do not chase trends here. We study them. We do not sell dreams. We examine probabilities. Consider subscribing, not because of what happened yesterday, but because of what the data suggests is coming next. Think of it as keeping one reliable source in your research process, the kind that presents both sides before the market forces you to choose one. And leave a comment below. Where in the world are you watching this from? Lahore? London? New York? Singapore? Let us know. Because when markets move this fast, perspective from across time zones matters. Now, let us examine exactly what these numbers mean. On the morning of January 31st, 2026, investors around the world opened their trading platforms and saw 2 numbers that told a story most were not prepared to understand. Gold, $4,886 per ounce. Silver, $84.63 per ounce. For those who had been watching the markets closely, these figures represented something far more significant than simple price points. They represented the aftermath of one of the most violent corrections in precious metals history. Just 2 days earlier, gold had touched $5,608, an all-time record. Silver had reached $121.78, a level not seen in over 4 decades. And then, in a single trading session, both metals collapsed. Gold fell nearly 12% in one day. Silver dropped 31%. Billions of dollars in leveraged positions were liquidated. Margin calls were executed. Accounts were wiped out. The crash was swift, brutal, and for many financially devastating. But here is what the headlines were not showing. Here is what the panic was obscuring. Here is the number that mattered more than any other. Despite the worst single-day crash in over 40 years, gold was still up 13.12% for the month of January. Silver, despite its catastrophic fall, was still up 18.77% for the same period. This is not opinion. This is mathematics. And mathematics does not respond to emotion. The question facing every serious investor on that Saturday morning was not whether the crash had happened. The crash was fact. The question was what these specific price levels revealed about the forces still operating beneath the surface of global markets. Because something remarkable was taking place. Something that contradicted the narrative of collapse and panic that dominated social media, financial news channels, and trading forums across the internet. While retail investors were selling in panic, a different kind of buyer was emerging. Central banks in China, India, Turkey, Poland, and Singapore had not stopped their accumulation programs. Physical gold dealers in major financial centers reported no significant decrease in institutional demand. In some cases, they reported increased buying interest at the lower prices. The crash, it appeared, had been concentrated almost entirely in the paper market, in futures contracts, in leveraged positions, in speculative call options purchased by traders who believed the rally would never end. The physical market, where nations store their reserves, where pension funds allocate for the long term, where serious wealth is actually preserved, that market remained remarkably stable. This divergence between paper and physical was telling a story about who was selling and who was buying, a story about the difference between speculation and strategic allocation, a story about what happens when leverage meets volatility in markets that billions of people around the world depend on for wealth preservation. JP Morgan's research division had published projections just days before the crash. Their analysts expected central bank demand for gold to average 585 tons per quarter throughout 2026. Their price target remained $5,500 per ounce by the fourth quarter. Their upside scenario, contingent on increased household allocations, projected a range between $6,000 and $8,500 per ounce. The crash on January 30th had not changed these projections. JP Morgan had not issued a revised forecast. The structural thesis, the fundamental case for why institutions were accumulating precious metals, remained intact. The same pattern appeared in silver. The Silver Institute had documented 5 consecutive years of supply deficits. Demand exceeded production, not marginally, significantly. And the primary driver was not investment demand, which could vanish overnight. It was industrial demand: solar panels, electric vehicles, semiconductors, artificial intelligence infrastructure, data centers requiring massive amounts of electrical components. A solar panel requires approximately 20 grams of silver, whether the market price is $121 or $84. An electric vehicle requires 25 to 50 grams regardless of speculative sentiment. This demand does not disappear because traders panic. This demand is structural. This demand is tied to the technological transformation of the global economy. HSBC had projected that the silver supply deficit would widen further in 2026. Not narrow, widen. That forecast was made before the crash. It remained valid after. So the investors sitting at their desk on Saturday morning, January 31st, faced a decision that would define their financial outcome for the year ahead. Were these prices, $4,186 for gold, $84.63 for silver, a warning to exit, or were they an opportunity to enter? The answer depended entirely on understanding what had actually happened beneath the surface of Friday's violence. And that understanding required looking at data most investors never examined. While the world was watching price charts collapse, a different story was unfolding in the corridors of central banks, the offices of sovereign wealth funds, and the trading desks of institutions that measure their positions not in weeks or months, but in decades. This story was not visible on any candlestick chart. It was not trending on social media. It was not being discussed in the comment sections of YouTube videos where traders mourned their losses, but it was happening. And it was happening at a scale that dwarfed the panic selling of January 30th. Between January 1st and January 31st, 2026, while speculators were buying call options and leveraging their accounts to chase parabolic gains, central banks across multiple continents had quietly accumulated an estimated 146 tons of gold. This figure, compiled from official reserve reports and international monetary data, represented a continuation of a trend that had been building for nearly 7 years. China's central bank had added to its reserves for the 27th consecutive month. The People's Bank of China was not buying gold because of a YouTube video. It was buying gold because of a strategic imperative that had nothing to do with short-term price movements. That imperative was reducing dependence on the US dollar in international trade and reserve holdings. India's Reserve Bank had increased its gold reserves to levels not seen since the 1990s. Turkey, despite facing its own economic challenges, had been accumulating gold at a pace that surprised many Western analysts. Poland's central bank had publicly stated its intention to increase gold holdings to 20% of total reserves, a target that would require purchasing hundreds of additional tons over the coming years. These were not traders. These were institutions managing the monetary sovereignty of entire nations, and their buying patterns did not change because of a single day's price crash. The same structural pattern was visible in silver, though the drivers were different in nature and perhaps more immediate in their implications. Global silver mine production in 2025 had totaled approximately 822 million ounces, according to preliminary industry data. Global silver demand for the same year had reached approximately 1.09 billion ounces. The deficit, roughly 268 million ounces, had been filled by recycling, above-ground stockpiles, and strategic reserves. But here was the problem that no amount of speculation or panic could solve. Those stockpiles were finite, and the demand was not slowing. It was accelerating. The solar industry alone was projected to consume over 200 million ounces of silver in 2026, up from 161 million ounces in 2024. This represented a 24% increase in just 2 years. And this was only one sector. Electric vehicles, consumer electronics, 5G infrastructure, medical devices, water purification systems. Each of these industries required silver in quantities that could not be easily substituted with alternative materials. A research team at HSBC had examined this supply-demand imbalance in granular detail. Their conclusion was unambiguous. The structural deficit in silver would widen in 2026 and likely persist through 2027 and 2028 unless either demand decreased significantly or new mine production came online at a pace far exceeding current projections. Neither scenario appeared likely. Mine development takes years. A new silver mine requires geological surveys, environmental permits, construction of processing facilities, and infrastructure development. The lead time from discovery to production typically ranges from 7 to 10 years. There were no major new silver mines scheduled to begin production in 2026 that would materially change the supply equation. And demand was not decreasing. Every major economy in the world had committed to carbon reduction targets that required massive deployment of solar energy. Every automotive manufacturer had announced electric vehicle production goals that required exponentially more silver than traditional combustion engines. The technological transformation of the global economy was not optional. It was mandated by policy, driven by regulation, and financed by trillions in government and private capital. This created a scenario that serious analysts were beginning to describe as a supply crunch in slow motion. Not a sudden shortage that would appear overnight, but a gradual tightening of available supply that would express itself through price volatility, delivery delays, and premiums in physical markets. The World Bank had published commodity forecasts in late 2025, projecting average silver prices near 31 per ounce for 2026. That forecast was made when silver was trading around 30. It had not been updated to account for silver's rise to $84, nor for the structural deficits that were becoming more apparent in industry data. Goldman Sachs commodity analysts had taken a different view. Their base case projected silver averaging $38 for the year, with potential spikes to $45 if industrial demand exceeded expectations. But even this forecast, made just months earlier, had been constructed on assumptions that the current price action had already invalidated. What none of these forecasts had fully accounted for was the possibility that silver's role in the energy transition might create demand that exceeded even optimistic projections, or that geopolitical developments might accelerate the timeline for technologies that required silver in substantial quantities. The investor watching these developments unfold faced a reality that was more complex than any single price chart could convey. On one hand, the fundamentals, the physical supply and demand, the central bank buying, the industrial consumption, remained constructive for higher prices over a multi-year horizon. On the other hand, markets did not move in straight lines. And the violence of January 30th was a reminder that sentiment, leverage, and positioning could override fundamentals for weeks or even months at a time. The question was not whether fundamentals mattered. The question was when they would matter again. There's a peculiar characteristic of financial markets that separates those who preserve capital from those who lose it. Markets do not hide their intentions. They broadcast them, loudly, repeatedly, through data that is publicly available, free to access, and visible to anyone willing to look. The crash of January 30th, 2026 was not a surprise. It was an inevitability that had been signaled for weeks through indicators that professional risk managers monitor obsessively and retail speculators ignore entirely. 3 weeks before the collapse, something unusual began appearing in CME futures data. Margin requirements for silver contracts had been raised, not once, 3 times in 2 weeks. Each increase was small, 5% here, 7% there. But the pattern was unmistakable. The exchange was seeing positioning that concerned them. They were seeing leverage that posed systemic risk. When margin requirements rise, it means one thing: too many traders are borrowing too much money to control too much metal. The exchange raises margins to reduce risk, but for traders already leveraged to maximum capacity, a margin increase is not a warning. It is a forced liquidation waiting to happen. By January 28th, open interest in silver futures had reached levels not seen since 2011. The last time open interest reached comparable levels, silver had peaked at $49 and then crashed 35% in 4 days. History was not repeating, but it was rhyming with precision. The relative strength index for both gold and silver had entered territory that technical analysts classify as extremely overbought. Gold's RSI had touched 82. Silver's had exceeded 90. An RSI above 70 is generally considered overbought. Above 80 signals that a correction is not just likely, it is imminent. Above 90 is rare, and when it occurs, the subsequent reversal is almost always violent. There were analysts who saw these signals. There were trading desks that reduced exposure. There were risk managers who moved to cash, but their voices were drowned out by a different narrative that had taken hold across social media platforms, investment forums, and even some financial news channels. That narrative was simple. Precious metals were going to the moon. Silver would reach $200, then $300. And on January 30th, reality imposed itself with the force it always does when speculation detaches from fundamentals. But here is what made that crash particularly instructive. It was not just the magnitude of the decline. It was the timing. It was who was nominated to lead the Federal Reserve on the same day that precious metals began their collapse. Kevin Warsh, former Federal Reserve Governor from 2006 to 2011. A man whose monetary policy philosophy was formed during the financial crisis of 2008. A man who had argued, even during the depths of that crisis, that the Federal Reserve should not engage in aggressive quantitative easing. A man who believed that maintaining the integrity of the currency required accepting short-term economic pain. His nomination was announced on Friday morning, January 30th. By Friday afternoon, gold had fallen $700. Silver had lost $38. The market was not reacting to what Warsh might do. The market was reacting to what Warsh represented, a potential return to monetary orthodoxy, a Federal Reserve that prioritized price stability over asset price support, a central bank that might allow interest rates to remain elevated far longer than markets had priced in. Bloomberg's senior commodity strategist, Mike McGlone, published commentary within hours of the crash. His assessment was direct and uncomfortable for those still holding leveraged positions. The higher metals had risen, the greater the probability that 2026 would mark enduring profit at the peak, would endure losses that would test their conviction and, in many cases, destroy their capital. There was another warning embedded in the price action itself that most observers missed entirely: the gold-silver ratio. This ratio, the number of ounces of silver required to purchase 1 ounce of gold, had compressed to levels rarely seen in modern markets. At the peak, on January 28th, the ratio had touched 46.1. Historically, the average ratio over the past century had been approximately 60.1 to 70.1. When the ratio compressed to extreme levels, as it did in 1980, in 2011, and again in January 2026, it signaled that silver had risen too far, too fast, relative to gold. And every time this compression occurred, it was followed by a sharp expansion of the ratio, as silver corrected more violently than gold. By the close on January 30th, the ratio had expanded to 57.1. Silver had fallen 3 times faster than gold. The ratio was telling the story that the price charts were screaming silver's rally had been excessive and the reversion was not complete. Technical analysts studying chart patterns identified another concerning signal. The daily candlestick formation on January 30th was what traders call a bearish engulfing pattern, a reversal signal that appears when a down day's price range completely engulfs the previous day's range. When this pattern appears after an extended rally, it often marks the beginning of a trend change, not just a single day's correction. For gold, the next critical support level was identified at $4,700. If that level failed to hold, technical analysts projected a potential decline to $4,200 or even $3,900, the 50% Fibonacci retracement of the entire rally from the 2025 lows. For silver, the technical picture was even more precarious. Support at $80 was tenuous. A break below that level could trigger another cascade of selling towards $65 or $70, where the 200-day moving average would provide the next meaningful support. These were not predictions. These were probabilities based on historical price behavior, market structure, and the psychology of crowds. Markets move in patterns because human behavior moves in patterns. Fear and greed, euphoria and panic, leverage and liquidation. The warnings had been visible. The data had been public. The risk had been quantifiable. The only question was whether anyone had been paying attention. In the aftermath of extreme market events, 2 types of participants emerge. The first type searches for certainty. They want to know what will happen next. They want someone to tell them whether to buy or sell, whether the bottom is in, or whether more pain is coming. They want answers that markets are structurally incapable of providing. The second type recognizes that markets do not offer certainty. They offer probabilities. And the discipline required to navigate those probabilities separates wealth preservation from wealth destruction. For the serious investor watching gold at $4,886 and silver at $84.63 on January 31st, 2026, the path forward required abandoning the need for certainty and embracing a framework built on risk management, position sizing, and strategic patience. The first principle of this framework was simple but uncomfortable: do not chase the bounce. When markets opened on Monday, February 2nd, there would be movement. Perhaps gold would rally $150. Perhaps silver would jump $8. And across every social media platform, voices would declare victory. I told you it was just a shakeout. We are going to the moon. Load up before it is too late. History showed what happened after declarations like these. The first bounce after a major crash was almost always a trap. It lured back in the traders who had sold in panic, desperate to recover their losses. It attracted new speculators who believed they were buying the bottom. And then, in many cases, the second leg down began. Professional traders understood this pattern. They did not rush in on Monday morning. They waited. They watched volume. They watched whether the bounce was accompanied by genuine institutional buying or simply short covering and retail speculation. They watched whether prices could hold gains or whether each rally attempt was met with renewed selling. Patience in the days following a crash was not passive. It was strategic. It was the discipline to let the market prove its direction rather than gambling on hope. The second principle addressed a question that should have been asked before January 30th, but was now critical: position sizing. An investor who had allocated 10% to 15% of their portfolio to precious metals experienced a painful day on January 30th, but their portfolio survived. Their other holdings, stocks, bonds, real estate, cash, absorbed the impact. They remained financially intact and psychologically capable of making rational decisions. An investor who had allocated 50%, 70%, or 90% to leveraged precious metals positions experienced something different. They experienced catastrophic loss. Accounts were liquidated. Capital was destroyed. And the psychological damage from such losses often led to worse decisions in the weeks that followed. Panic selling at bottoms, revenge trading, abandonment of any coherent strategy. Position sizing was not exciting. It did not generate viral content. It did not promise quick wealth. But it was the mathematical difference between surviving market corrections and being eliminated by them. For precious metals specifically, institutional guidelines typically recommended allocations between 5% and 15% of a diversified portfolio. Some aggressive allocators pushed to 20% under specific macroeconomic conditions. But beyond 20%, the position ceased to be an allocation and became a speculation. And speculation, by definition, carried the risk of total loss. The third principle required developing the ability to separate signal from noise in an information environment designed to exploit emotion rather than inform judgment. In the week following January 30th, hundreds of videos would be uploaded. Hundreds of articles would be published. Thousands of posts would circulate claiming to know what was coming next. The vast majority would be worthless. Not because the creators were malicious, but because they were operating from the same emotional impulses as their audiences. A framework for evaluating information quality required asking specific questions before accepting any analysis as credible. First, does the source use emotional language designed to trigger action rather than thought? Words like diamond hands, phrases like we showed them, references to legendary behavior. These were not analytical terms. These were tribal signals. They created group identity. They rewarded loyalty over accuracy. They were the language of movements, not markets. Second, does the source construct enemies to explain market movements? The banks want you poor. Wall Street is manipulating prices. When analysis required an adversary, it was not analysis. It was narrative construction. Markets moved based on supply and demand, positioning, and policy. Conspiracy theories were intellectually comfortable because they absolved the believer of responsibility for their losses. But comfort and truth were different things. Third, does the source employ artificial urgency? Monday will gap up. Last chance to buy. This is it. Urgency was a sales tactic. It exploited fear of missing out. It pressured decisions that should be measured and deliberate. Legitimate analysis presented time frames, probabilities, and conditional scenarios. It did not demand immediate action. Fourth, does the source present only bullish information while hiding bearish data? Every honest analysis contained both cases. Markets were complex systems with multiple forces operating simultaneously. An analysis that showed only reasons to buy was not informing, it was selling. The fourth principle was perhaps the most difficult to implement because it required accepting uncertainty. Wait for confirmation. Technical analysts monitoring precious metals would be watching specific levels in the days and weeks ahead. For gold, the $5,000 psychological level was critical. A reclaim and hold above $5,000 would suggest that Friday's low near $4,800 represented the bottom of the correction. A failure to hold $5,000, followed by a break below $4,800, would indicate that further downside remained. For silver, the battleground was the $85 to $100 range. A weekly close above $100 would be significant, and potentially mark the beginning of a new leg higher. A failure to reclaim $98 and a subsequent break below $80 would be concerning, and suggest that the correction had further to run. But here was the challenge. No one knew which scenario would unfold. Not the analysts at JP Morgan, not the strategists at Goldman Sachs, not the technical experts with decades of experience. The future was unknowable. What separated professional risk managers from gamblers was not their ability to predict the future. It was their willingness to wait for the market to show them the direction before committing significant capital. This meant watching price action without participating. It meant allowing the first moves after the crash to develop without trying to front-run them. It meant accepting that missing the first 10% of a new move was preferable to catching the full weight of a continued decline. Patience was not inaction. Patience was disciplined observation. It was the recognition that capital preservation mattered more than opportunity maximization. It was the understanding that there would always be another trade, but only if capital survived to take it. These four principles: Avoiding the chase, sizing positions appropriately, filtering information rigorously, and waiting for confirmation formed the foundation of a framework that could be applied not just to precious metals in February 2026, but to any market, at any time, under any condition. Because markets changed, assets changed, economic conditions changed, but human psychology remained constant: fear and greed, panic and euphoria, the impulse to act and the discipline to wait. The investor who mastered these principles would not win every trade, would not call every top or bottom, would not achieve the mythical perfect entry and exit that existed only in hindsight. But they would survive. They would preserve capital through corrections. They would be positioned to participate when fundamentals reasserted themselves. And over years and decades, survival compounded into something that speculation never achieved: lasting wealth. Gold at 4,886, silver at 84 to 63. These were not just prices, they were a test of discipline, a test of understanding, a test of whether lessons learned in previous cycles had been internalized or forgotten. The market would reveal, in the days and weeks ahead, who had learned and who had not.